Tom, were you getting nervous here with what the market was doing? I know you expected things to go a lot better for the major indices this year.
Yeah, John, I was getting very nervous. I think the biggest sign was I was going to bed every night, checking futures, reading everything, and wondering if the market would open limit down. So I was getting very nervous. But of course, now this is a really big positive fundamental development. I'm going to have to make some guesses here, but I think one of the positives is that I think the White House exercised the Navarro put, meaning they are now inserting Bessent more into the negotiating process, which I think is less of a hardline view. When I look at what this means for the next few months, I do think because of the tariffs and they've been dialed down.
It's been a roller coaster year for investors, with even the most optimistic strategists feeling the strain as markets defied expectations. The major indices, which many predicted would see smooth sailing in 2025, instead delivered white-knuckle volatility, leaving Wall Street scrambling for answers. But just as uncertainty peaked, a critical shift emerged that could redefine the path ahead. Tom Lee, never one to sugarcoat his views, openly admitted the turbulence had him on edge. He found himself checking futures late into the night, bracing for another chaotic open. The stress was real, but now he sees a meaningful catalyst that could flip the script. Lee highlights what he's calling the Navarro put, a softening in the White House's trade stance, with dialed-back tariffs and a more pragmatic approach to negotiations. In his view, this isn't just a short-term bounce, but a genuine inflection point. For businesses, the reduced pressure on guidance and earnings could be a game-changer. And for investors who held their nerve, this might finally be the payoff. The big question now? Whether this momentum has legs, or if it's just another twist in an unpredictable year. Either way, Lee's message is clear. The worst-case scenario looks a lot less likely today. While Tom Lee makes a compelling case for Bitcoin's potential decoupling from traditional markets, crypto hedge fund veteran James Lavish brings a different lens to the conversation. Let's watch clips from James Lavish's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
The markets hate uncertainty. And when, what we've seen is, if we look at the markets through a kind of a Bitcoin lens, but the overall market, what we've seen is Trump was elected and this new administration came in and they have been very pro-crypto, pro-Bitcoin. They immediately came right out of the gates and he issued an executive order within weeks of starting his term, and that executive order was to establish a Bitcoin strategic reserve, and so that was supposedly a kind of a gating event, and that Bitcoin would rally off of that, but it didn't rally; it fell, and so it was confusing to people, the outsiders. They didn't understand what was going on, but really what was going on is that the Bitcoin investors. And people were speculating that strategic reserve would include some sort of measure to buy Bitcoin. Okay, so there was no measure to buy it. There's only a measure to add to it in a budget neutral sense, or in a budget neutral way. So Bitcoin dropped. So what we've seen is Bitcoin, after Trump was elected, had a great run to all-time highs of just about 110,000, just under that, and then it kind of faded from there. And it faded for multiple reasons. We started getting some economic data that was suggesting just more inflation. Bond prices were, they were dropping and rates were rising. And that was because people are expecting for more bond issuance, massive bond issuance, and more inflation and possibly stagflation. And so started getting some market uncertainty there. Bitcoin started to draw down, fell below 100,000. Then we get that strategic reserve announcement and it really starts getting hit and people were disappointed. And then you had a steep drawdown with market uncertainty and tariff threats, like you said. And Bitcoin draws down a total of 30% from the all-time high. And so it starts to climb back, and you get this continuing uncertainty in the market. And like you said last week, then we started to see that kind of watershed moment where investors realize, oh, he is dead serious. This isn't a threat. Like, he's going to really enact these tariffs. And the general market got very nervous and started selling the risk assets, started selling the S&P. And Bitcoin went down ahead of it and with it. And then Friday came along, and the market opened down 3% on the opening, which was a gap down of 3%. But Bitcoin was up from the day before, and it was kind of perplexing. So the question is, has Bitcoin really decoupled from risk assets? Are people looking at it and saying, all right, this is what I want to own? Like, even gold was down. And are they saying, do I want to allocate to Bitcoin because there's so much uncertainty in the world? Or is it that Bitcoin drew down first, and now it's found a spot where it's going to hold steady here, and it's really found a bottom? It's already had that local bottom. And that's the question. And that's what everybody's trying to figure out. The last time Bitcoin really did this in earnest was when Silicon Valley Bank collapsed. And the market started to, the general market sold off hard, but Bitcoin rallied after that. And so, the question is, did it rally because people were assuming that there's going to be money printing to kind of paper over the problems, the banking problems? Or did it rally because people were concerned that, look, I've got money in the bank. Clearly, my deposits could be wiped out, and it may not be covered by the federal insurance, FDIC. So I want to own something that can't be touched and that I can self-sovereign. And I think that was really a big part of it, that in that moment, that people realized, oh my God, these banks, if they collapse, I could lose all my savings, or I could lose whatever's I have there. I can move it over to something that the banks don't control, get it out of the bank. But if you get out of the bank, where are you going to put it? You put it in investments, you can put it in the money market, you're going to put it or do you put it in something? So that was the first real, that was the first real decoupling for a moment there. And I don't think this is that. And I don't think it's the same thing, because that was kind of an event. Now, so the tariffs, they can be seen as kind of a one-time event, in that the tariffs are set, it's a one-time repricing, and then, we move forward. It could be seen as that, and the market will adjust around that, but the fallout from it is really uncertain.
Second order effects, yeah.
Correct. So the question is, how long does it take for these companies they have to, some of them have to pivot, some of them have to just reorganize their business around certain lines. Some of them have to build facilities here in order to start getting better margins again. So it takes time, like you said. So what I want to see is, I want to see a sustained decoupling. And even if it's the market's going up and Bitcoin's not going up, or the market's going sideways and Bitcoin is, doing its own thing, as long as it's not directly correlated to the NASDAQ, that's a really good sign to me that Bitcoin is decoupled. But to me, that's not just a couple of days or weeks. Like, that's got to be months and months of that. And so it remains to be seen whether we're on that path or not.
Markets hate uncertainty, and right now, there's plenty to go around. But Bitcoin? It's playing a whole different game. When the new administration stormed into office with a pro-crypto stance, expectations went parabolic. A Bitcoin strategic reserve was announced. Finally, institutional adoption. Yet instead of rallying, Bitcoin tanked. Why? Because traders expected direct purchases, not just bureaucratic planning. The disappointment was instant. A 30% plunge from its $110,000 highs as inflation fears, bond market chaos, and tariff threats piled on the pressure. Then came last week's plot twist. While the S&P cratered 3% at Friday's open, Bitcoin climbed, defying its usual risk-asset correlation. Was this the long-awaited decoupling, or just a dead cat bounce? History offers clues. During the SVB collapse, Bitcoin surged as depositors fled shaky banks for hard, self-custodied assets. But tariffs aren't a bank run. They're a slow-burn economic reshuffle. The real test? Sustained divergence. If Bitcoin keeps marching to its own drumbeat for months, regardless of Nasdaq mood swings, that's the signal crypto maximalists are waiting for. For now, the market's verdict is still out. One thing's clear, though. In a world of Fed prints and trade wars, Bitcoin's next move could redefine its role entirely. Let's watch more clips from the interview.
Is Bitcoin gaining share of that? Is it getting larger as a share of those investable assets? Or is it just following the expansion of the money supply that it goes from 900 trillion to 1 quadrillion to 1.1 quadrillion? Is it just following that? So that's the question. And as adoption continues, is it breaking away and saying, this is now a separate asset, a store of value? And really, to answer your question about institutions and pension funds and endowments of traditional money managers, the real traditional institutions, it's when do they start to understand that Bitcoin is not a risk-on asset? When do they start to understand that it is truly a separate store of value? It's a scarce store of value and the ultimate risk-off asset when you step back and understand it truly. So when do they get to that understanding? And I think that we're starting to see that's accelerating. They're not adopting it yet, but that the research and the knowledge base is expanding. And that has to do with what we talked about at the beginning, which is the US government is now, they're investing in Bitcoin. And so the game theory is not just sovereigns, but it's everybody. If the US government is investing in Bitcoin, why am I not investing in it? What am I missing? What am I missing as a traditional money manager that I'm not looking into this and I don't see it the same way as other people do? And so as that occurs, and we ultimately get the Bitcoin Act passed by Senator Lummis, whenever that happens, it may take months, it may take years, but once that happens, then you've got the traditional money managers that will say, okay, now it's moved from a risk to own asset to a risk of not owning any asset. And I've got to treat it separately in my portfolio. The US government is focused on stablecoins, and they know that stablecoins will allow for just a broader adoption and usage of treasuries, meaning that if you're in an emerging market, emerging country, and it's not developed, and you want dollars, how do you get those dollars? Now, if you have an on-ramp to an exchange and you're able to buy stable coins, the stablecoin legislation is important because it'll show it will create that set of rules around anybody owning stable coins, institutions, and like we talked about, individuals, and that the stable coins just own, what do they own? They own treasuries. So that's really important first, and I think that's what they're focused on right now. Then you've got the Bitcoin Act, right? And then you've got what Andrew Hone is talking about, which is the Bitcoin bonds, right? The BIT bonds. And so, how does that happen? Well, again, broader understanding in the government about exactly what Bitcoin is and why it is so important to hold and to get access to as an asset on your balance sheet. And by issuing those bonds and using some of that capital, most of it, so the concept is to issue a treasury, use most of that capital for operating expenses of the US government treasury, and then some of it to buy Bitcoin. And then the bond holder would get access to a return that's linked to both an underlying interest rate for that bond and some upside that's associated with the Bitcoin to a certain point. And then the US government and the investor splits the upside from there. I think the most probable path is continued volatility, which means that it's not stair step and it's not just a jump up to the next plateau. It's more like this. And then you'll see one big jump up from that volatility, and then it'll form that new plateau, which is kind of like what we've seen recently. You have the volatility up to 60,000, kind of held that plateau. You have volatility now to over 100,000. It's kind of holding the 80 plateau. So does it then have the volatility of doubling in size overnight? So it's absolutely possible for Bitcoin. If you have the passage of the Bitcoin the Bitcoin Act, okay, or you have something like the U.S. government announced they've sold gold to buy Bitcoin. They probably wouldn't announce it first. They probably do it, and then or you have a large nation state announce that they bought Bitcoin, right? So it's maybe one of the BRICS nations, or maybe another developed country like Germany. Like, if that ever happened, I don't see that yet. But or the EU, or if you had a very large corporation adopt Bitcoin in their treasury strategy, and not doing the volatility play like Michael Saylor is doing for MicroStrategy, but something like a Microsoft or an Apple or one of these massive companies that are holding, tens of billions of dollars on their balance sheets, and they turn around and start buying Bitcoin. That could then propel it to a level, increase volatility for a moment, but to the upside mostly. So, and that's what I'm looking for.
Yeah. So you don't necessarily expect the ugly candle one night, and you don't necessarily expect it to be a slow grind, but up and down, pain both ways.
Yeah, pain both ways for a while, but that's good. We embrace the volatility because it gives opportunity.
The cryptocurrency market is currently facing major fluctuations, largely driven by global political instability, including the trade tensions sparked by U.S. President Donald Trump. Despite this, Bitcoin has remained resilient, holding steady above $80,000 per coin, although it has significantly fallen from its January peak of nearly $110,000. This downturn has wiped out over $1.3 trillion in market value across Ethereum, XRP, and other cryptocurrencies. However, amid the volatility, there is a growing sense of optimism about the future of crypto, particularly in the area of asset tokenization. Tokenization, which involves converting physical and financial assets into digital tokens on a blockchain, is rapidly gaining traction among financial institutions. Major players like BlackRock, the world's largest asset manager, have been at the forefront of promoting this shift. BlackRock, which previously dismissed Bitcoin as an index of money laundering, now recognizes it as a legitimate financial instrument and is backing the development of Bitcoin ETFs. The firm's commitment to blockchain technology highlights a broader trend where traditional financial markets are looking to digitize assets such as stocks, hedge funds, commodities, and even infrastructure projects. Experts predict that the tokenization of real-world assets will grow exponentially, with the potential to expand from $600 billion to $19 trillion by 2033. This massive growth will likely reshape the financial landscape, as blockchain technology continues to evolve from a speculative investment tool to a core part of the global financial infrastructure. As the market matures, cryptocurrency is positioning itself to play a key role in transforming capital markets, making it an exciting time for investors and financial institutions alike. The future of digital assets looks brighter than ever, and the next decade could bring a revolution in how we manage and trade assets worldwide. Thanks for watching. Please share this video, hit the like button, and don't forget to subscribe.